She cries at the commercials by AT&T. She sobs at the videos on MTV, but she says it's got nothing to do with me. She's just an emotional girl. She rips off my suits and cuts off the sleeves and shaves my head while I'm fast asleep. Sometimes I feel she's the princess and I'm just the pea. She's just an emotional girl. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. Hey everybody, Dave here at Hidden Freedom Investing. In today's video, we're going to go over AT&T's Q3 results for 2020. We're going to look at the earnings and see what happened, why the stock went up, why it went down, and kind of see where everything's sitting at now, a little unbaked results, and go from there. So recently I did a Q2 results video. If you want to take a look at that video up here just as a reference, go ahead and take a look at that video. And just to let you know, I will not be trying out for American Idol anytime soon, so please don't thumbs down the video on my singing ability, all right? So I just wanted to throw that in there from one of the movies that I watched one of my favorite actors in, Joel David Moore. All right, so that little tidbit there that I did was from the movie Hottie and the Naughty. Another movie he is in Grandma's Boy, which he was brilliant in my opinion. So if you haven't seen those two movies, go ahead and take a look at those two movies. So let's go ahead and get dug into AT&T. All right, we are looking at the income statement here and operating revenues. We're going to compare this recent Q3 against Q2. So they have over $42 billion, $42.3 billion of revenue. And that's compared to last quarter's $40.9 billion. So there's a substantial increase there of revenue. And scrolling down here a little bit, let's see here. Total operating expenses actually decreased quite a bit, about $1.4 billion or so. Operating income here went up, didn't quite double, but it was a substantial increase from Q2. That's $6 billion compared to last quarter, $3.5 billion. Moving on down here, we got net income here of $3.1 billion compared to last quarter's $1.5 billion. So that is a humongous increase from last quarter. And like I said, we talked about in the last video, I think pretty much things would start to improve. The pandemic is starting to be over with and things are starting to return. Sports are starting to return and all that. So movies haven't quite come back, but we'll kind of touch on that when we get to the business segment. So looking here at the cash flows, we got net income, which is carried down from above. So that's $3.1 billion compared to last quarter's 1.5. We kind of just want to touch on the debt here because they did quite a bit of debt restructure in Q3. Looks like they paid back about $20 billion and they also took out some new debt as well. They did restructure quite a bit of debt. I think it was $30 billion total. And also refinanced that down to under 4.1%, took advantage of these reduced interest rates and kind of moved those things out into the future. In addition here, it looks like we had dividends paid of about $3.7 billion for Q3. We'll touch on the dividend a little bit later in this video as well. Financial and operating statistics summary. The thing that we want to kind of mention on this particular slide here is the debt ratio. So the debt ratio is 44.9. And that's a substantial decrease from Q2 of 46.6%. We also want to mention the total employees here of a reduction from 243,000 down to 234,000. So that is a pretty substantial decrease in workforce there. I know that FinViz still has it shown as 243, and that's the reason why I kind of mention it here, that they did reduce their workforce. They did close some stores. We'll kind of touch on that later on in the video as well. So let's look at a little bit of the business segments here. Operating revenues, obviously with $42.3 billion compared to last quarter's $40.9 billion. And we look at communications there, $34.2 billion compared to last quarter's $33.5 billion there. And looks like we had mobility, which was a pretty good incline, $17.8 billion compared to last quarter's $17.1 billion. That is the phone market there. Obviously, we got the iPhone 12 coming out. And I think on the earnings call they mentioned that that's a pretty strong, or Q4 is going to be a pretty strong quarter for them because of the iPhone 12. People want an upgrade and get 5G and all that. So we'll probably look at a substantial increase for Q4 for the mobility and going forward, but that's still, you know, nonetheless a pretty substantial increase from Q2. Entertainment group there, we had pretty much, you know, remained flat. And the business wireline there was, you know, pretty much remained flat as well. Warner Media, let's see, 7.5 billion compared to last quarter's at 6.8 billion. And, you know, obviously they had quite a bit of subscriptions on the Human Body Over, which is HBO. That's 1.7 billion compared to last quarter's at 1.6 billion. And the Turner Media there, which is a pretty substantial increase, 3.1 billion compared to last quarter's 2.9 billion. And the Turner there encompasses what? TBS, TNT, Cartoon Network, and the Cheater News Network, or, you know, AKA CNN. We got Warner Brothers there of 2.4 billion, and compared to last quarter's 3.2 billion. That is a substantial decrease, and obviously movies have been shut down. They shut production down earlier this year. I believe they are starting up production again now. And I don't think theaters are even open yet. Maybe some are around the country, but they are starting production. But, you know, obviously, I don't think they're going to finish anything for the rest of 2020. So that was a slight of a decline there. So we break these segments down. We'll just kind of look at the highlights for the different segments here. So this communications, an overview of the communications revenue, 34.3 billion, down 3.1% year over year due to declines in entertainment groups and business wireline, partially offset by gains in mobility. And this is a little bit breakdown of the mobility revenue is obviously 17.9 billion, up 1.1% year over year due to higher equipment revenues, offset service revenue pressures from lower international roaming revenue. Now we did mention that in the last quarter. Nobody's traveling internationally, or it's very limited, so they're, you know, suffering on the roaming where they get a pretty substantial amount of their income from. So that is where a little bit of the revenue got hit. Let's see, service revenues 13.9 billion, down 0.3% year over year due to decline in international roaming services, which we just talked about there. Equipment revenues 4 billion, up 6.4% year over year, driven by a mix of higher priced postpaid smartphones and higher sales of data devices such as wireless modems and hotspots. And kind of digging into those numbers a little bit further, postpaid phone only ARPU, which stands for average revenue per user, of 54.70 decreased 2.1% versus a year ago due to lower international roaming revenue, which we just talked about. And subscriber metrics here, total net adds of 5.5 million to reach 176 million in service, over 776,000 total phone net adds, postpaid and prepaid. Churning here, they did talk about that in the earnings call a little bit. Postpaid churn 0.85 versus 1.19 in the year ago quarter. And that's kind of excluding the KAC, which is the Keep Americas Connected. Postpaid phone churn 0.69 versus 0.95 in a year ago quarter. Prepaid churn of less than 3%. Now they did mention that on the earnings call that was the best ever churn, the lowest churn they've ever had. And looking at the entertainment group here, 10.1 billion, down 10.2% year over year due to declines in premium TV and over-the-top OTT subscribers, impacts of the pandemic and declines in legacy services. IP broadband 2.1 billion, up 0.5% year over year due to higher ARPU, resulting from an increase in high-speed fiber customers and pricing actions. So they did pick up quite a bit of broadband subscribers. We'll talk about that a little bit later on in this video as well. Obviously, people staying home, they need to have broadband, and they might be upgrading their services. They might be bundling, which we'll talk about as well. And looking at the subscriber metrics here, we're going to kind of look at a couple of these things. Premium TV subscribers, which includes the dreaded DirecTV. That thing just, they can't get away from it. 590,000 loss AT&T TV now subscribers 37,000 net loss to less promotional activity. There's a lot of other options you go to. You can go to Sling and you can go to YouTube TV. There's a lot of other options right now. So I think even Comcast has an option as well. There's fight for the lowest to the bottom, I guess, or fight for the bottom. Hopefully, that's good news for us. Hopefully we can get things cheaper. AT&T has increased their dividend 37 consecutive years. Go ahead and like and subscribe and hit that bell notification. So somebody mentioned in a comment in my last Q2 video on AT&T that they'll never use AT&T ever again in their life. And I kind of understand that because they're still operating a little bit on old methodology or whatever you want to call it, where they want to sign you up for a 2-year agreement, and if you don't cancel early or something like that, then they're going to charge you more, or a cancellation fee or something like that. And YouTube TV, Sling, they have like zero cancellation charges. You don't have any agreement or anything like that, a 2-year agreement. They don't have any of that stuff. So I think that AT&T needs to get their crap together and change that. And they did talk about that a little bit on the earnings call, and said, why are people leaving us? And they kind of did a study on that and found out why people are leaving leaving their business and leaving their products. And I think they got to the root of that, and that's probably came up in there. They didn't mention that specifically, but I bet you that came up in there. Nobody wants to sign a 2-year agreement, and nobody wants to pay a cancellation fee and all that. Total broadband subscribers, 158,000 net adds, impacted positively by the pandemic, and 104,000 PAN accounts related to CAC. So people needed broadband. They're teaching their kids at home, they're streaming more, they're working from home, so they need to have broadband. Not to mention that AT&T might try to bundle, AT&T TV in there, maybe even try to bundle HBO Max in there. More than 90% of all broadband subscribers on AT&T's fiber network subscribe to speeds over 100 megabits or more. More than 2.8 million fiber subscribers have taken 1 gigabit speed. 1 gigabit customers increased by more than 800,000 in the quarter. That is amazing. And we'll kind of dig down a little bit deeper here. $7.5 billion, down 10% year over year, driven by declines across Warner Brothers and home box office, aka HBO, and partially offset by an increase at Turner. So, obviously there's a decline at Warner Brothers and home box office. They're not making any movies. Those got pushed off. The home box office drop off there was partially due because of the original content. They couldn't make it. That got pushed off as well. Now, granted, they do have a library of existing content out there that people can leverage, but as far as original content, a lot of things got pushed off until 2021. And partially offset increase at Turner. So obviously Turner is TBS and Cartoon Network and TNT and Cheater News Network, CNN. There was no sports on TNT. That's where I pretty much watched NBA, and so there's slight increase, but revenue there, but it was still a decrease from where they're normally at because of no sports and all that stuff. Digging into the Turner here a little bit deeper, so revenues $3.2 billion, up 5.6% year over year due to an increase in advertising, content, and other revenues, partially offset by a decrease in subscription revenues. So people might have unsubscribed, maybe went to Sling, maybe went to YouTube TV, maybe they wanted to watch NBA, and because it was got pushed off, maybe they unsubscribed. And we're going to touch on the human body odor, HBO here, revenues of $1.8 billion, down at 2.1% year over year, reflecting a decrease in content and other revenues, partially offset by an increase in subscription revenues. Content and other decreased due to lower licensing revenue. So HBO, most of the stuff that they make is their own content. I think they mentioned on the conference call that it was only like one thing that they actually had to license. Everything else is original to AT&T. So that's, obviously they don't have to pay a lot of money for licensing. Looking at the Warner Brothers here, revenues $2.4 billion, down at 27.7% year over year due to declines in television, theatrical, and games and other. theatrical product decreased primarily due to postponement of theatrical and home entertainment releases caused by the pandemic. Tenet global release impacted by limited capacity and continued closure of movie theaters in many locations. So I think they're going to resume that. I think they said they had 180 productions going on at the beginning of this year, and I think they're now resumed up to 130 of those. If I understood the conference call correctly, they speak strange lingo on those conference calls if you never listened to one. So we'll look forward to that into 2021. And let's go ahead and look at this money slide, because this one kind of sums up what's going on here. So strong cash flow support debt reduction and dividend payout ratio. Third quarter of 2020, free cash flow of $8.3 billion. All right, year to date, free cash flow of $19.8 billion. All right, net debt at $149 billion. I know people hate this company. They hate the debt. That's all you hear about is the debt. All right, and they just literally probably won't invest in the company because of the debt. All right, so that's down from $180 billion, and that's since the Time Warner acquisition of over 2 years ago. All right, so that was $180 billion. They're down over $30 billion. All right, so they're paying that debt down. Dividend payout ratio of 45% in Q3 of 2020, and that sets the year to date at 57%. All right, so I think that Seeking Alpha and I think that FinViz has the payout ratio incorrect. It shows it over 130%, I think, on FinViz. And I think on Seeking Alpha, which Seeking Alpha is just way off recently, I think Seeking Alpha is at 65% currently, so it may need to be updated. Proactive debt management provides flexibility and sufficient liquidity. All right, 50% reduction in maturities over the next 5 years provides flexibility and manageable near-term debt towers. Overall weighted average maturity of 17 years at 4.1%, improved from 13 years at 4.3% at Q1 2020. So they restructured a lot of debt in Q3. $10 billion cash balance at the end of third quarter of 2020. So those are some major positives right there. Paying down that debt, they paid $30 billion down in debt, and they still have a cash balance of $10 billion. Strategic review of monetization and non-core assets continue. $3 billion plus in asset sales announced, expected to close in Q4 of 2020, includes CME closed, and the Puerto Rico expected to close in October, exploring sale of non-core assets, services, and other businesses. So what they're trying to do is they're trying to dump that DirecTV, which we talked about in the last video. All right, I mentioned that they're going to try to find a sucker to buy that darn thing, because every quarter that thing is just going down in value. Here are the business priorities going forward. Focus on market-based priorities, 5G wireless and fiber-based connectivity, expanding reach to software-based entertainment platforms. They did mention that they were going to be working on their software app and trying to make it better as well. Relentless commitment to customer experience, and they talked about that on the conference call as well. The fact that they want to find out why customers are leaving, get rid of these cancellation fees, get rid of early termination fees, or whatever you want to call it. Get rid of the 2-year or 3-year commitments and all that stuff, because that's just 10-year, 20-year ago mentality. Being effective and efficient in everything we do. Transformation efforts ramping, improving customer experience with evolving customer needs, positioning company for post-pandemic environment. So that means they're going to start ramping up the production of original content and movies and all that stuff. Improve balance sheet and deliberate capital allocation, investing in strategic growth areas, 5G, wireless, fiber, and HBO Max, committed to supporting dividend, solid 36-year record. Oh yes, they're a dividend aristocrat if you didn't know. All right, do not go by what Seeking Alpha shows, it is wrong. Further debt reduction, focus on metric improvement, continue portfolio review, monetizing non-core assets. So they're going to basically do what a lot of other companies are doing right now, like Cisco, IBM, and Intel. They're going to dump some of those, lower profit margin, crappier business segments and just sell those things off and focus on their bread and butter, where they're making or the core of their money is coming from. So looking at a chart here with AT&T, so this little pop-up right here was the Q3 earnings. So the Q3 earnings came out on October 22nd, BMO, which is before market open, and that's what it was right there, because it came out before market open. It actually gapped up, and we take this little trend line here, we draw it down, and pretty much went up right to the trend line. And then the next few days it sold off, and I have a feeling the reason why I did that was people were taking profit, they wanted to get out of it, and because they didn't really know what was going to happen with the elections. That's just a little bit of a speculation there. So the elections were right around here, and then it kind of gapped up right there, and then we're kind of maintaining above that 50-period moving average there, right around the 28 level. So kind of go over some of these numbers here. Like I talked about, the employees actually reduced from 243,000 down to 230 something. So FinViz needs to be updated a little bit. Forward PE 8.8. And kind of mentioned here, the target here is 3160, and we're sitting about the 28 level right now. So there's quite a bit of upside there up to the 200-period moving average, which is about 3170-ish. We are off the 52-week low about 9% at this point, but we're still down 27% year to date. AT&T has reduced their debt by $30 billion. Go ahead and like and subscribe and hit that bell notification. So looking at my dividend portfolio here, I do own AT&T, which I talked about in the last video, or the last AT&T video. So I do own AT&T. I said I was going to add down near the 26 level here. Here's AT&T right here. My average right now across my two accounts is 31.39. The stock sits at 28.44. The market closed today of November 12th. I am down at 9.4% in the stock. I did not add much to the stock, and partially the reason why I didn't want to do that, even though it was down at the 26 level, like I said, I was going to buy down there, I was going to load up the truck. I didn't want to make AT&T, the number one position, or kind of build it up past Johnson & Johnson and all that, so I didn't really add to it. If it does drop down, I might add a couple more shares. Sitting at what, 369 shares. There's still room to add a little bit. I don't want to overtake Johnson & Johnson and make it kind of big in my portfolio. Obviously, the communications sector sits at 6.9%, so there's a little bit of room to add there, considering the S&P 500 communication services about 10.8%. So I could add to AT&T, I could add to Verizon. There's still a little room there to add, especially since I'm going to probably be adding to Microsoft and Johnson & Johnson anyway. So scrolling over here, we can just kind of look at the dividend yield. The dividend yield is sitting at 7.3% right now. My yield on cost is 6.6%. This payout ratio is wrong, I believe. It needs to be updated. Now they do have a low CAGR. Well, we don't buy AT&T for a big CAGR. You want a big CAGR, go to Starbucks or something like that, all right? And right now we got consecutive years of dividend increases at 36 years of consecutive increases. That makes this a dividend aristocrat. So going forward, I think that this company is a buy at this point, or a hold, minimum. I'm not getting rid of my stock for sure. Q4 is going to be better than Q3, and Q3, pretty much stomped on Q2. We're on the down slopes of the beer virus at this point, in my opinion. They're launching HBO Max worldwide. All right, now they're going to be launching it just a couple areas in 2021 or early 2021, but they'll probably launch it out even more areas in 2021 or even going forward from there. We also have the SVOD, which I think is subscriber video on demand. So they're working on original content. They're going to resume some movies. I think they're working on 130 productions out of 180 right now. We got the return of sports as well. The elections are behind us. All right. We're also looking at doing AVOD, all right? So that's the ad video on demand. So they're gonna add a cheaper pricing plan. People that don't mind the ads, they're gonna get a cheaper price there. Reducing their workforce, they're also closing some stores, and they're also increasing their fiber network. They're also increasing their fiber connectivity with a bunch of households that run by the fiber but are not currently connected. So they're going to try to take advantage of that as well. 5G, the Apple iPhone 12, which they mentioned on the conference call that Q4 is pretty big for them. So I think Q4 is going to be better than Q3. So at this point, I might pick up a little bit more shares, try to keep the stock pretty relevant in my portfolio, not just, outweigh Microsoft and Johnson & Johnson, but I think I'm going to pick up a little bit more shares. Now there is a little bit of a unknown. You got the election there, the runoff in January 5th, you got the Georgia runoff for those 2 Senate races there. That is a little bit of a headwind, and we just, kind of an unknown that we have to worry about a little bit, but Biden's likely going to be the president. He's already president-elect at this point. So there could be an increase in taxes for AT&T, but at the same time, on the flip side, I should say, there could be an infrastructure bill that might actually benefit AT&T as well. So with that, I hope you enjoyed this video. If you have any comments, questions, or concerns, go ahead and leave a comment below. Go ahead and like and subscribe, and we'll see you in the next video. Thanks for watching.